Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Hello, everyone, and welcome to the Millionaire Next Door podcast. I'm Robert Curtis, your host. Thank you so much for being here. We have a guest with us today, Zach Levenick. Zach and I met a few months back at a conference down in Carlsbad, California. Found out our offices are really very close to each other in the same city. So we had a meeting and a lunch and really just got brainstorming on a lot of thoughts around markets and decided he'd be a great fit for the podcast to share his views. So please, Zach, welcome to the show. And why don't you introduce yourself and tell folks a little bit about what you do?
Thanks very much for having me on. It's great to be here and great to be with you. And thanks everybody who's listening. Give you 2 seconds of background on me and the perspectives I have. I spent about 20 years working at a large hedge fund based in New York and London and ran public and private businesses for us in those places as well as Latin America before moving back to Pasadena and meeting Robert 5 years ago or so when I moved. And since then have been investing on behalf of our family office and in conjunction with other family offices. We also, given our background, launched a liquid investment fund to tackle mispricings in smaller companies throughout markets in Western Europe and the US. And I help an endowment in town organize itself around the current investment landscape and take a very long-term view on value creation through investments. So have a really broad lens and a lot of different things we look at. That's how Robert and I had such an interesting and wide-ranging conversation. And hopefully we can talk about some things that are interesting for you today.
Yeah, for sure. I just want to let everyone know as we record this, it's June 25th of 2025. So a lot of these are very evergreen, but sometimes when they're a little more market, I like to highlight the date so we know the context of what we're talking about. I do hear a lot of folks, I want to get your sense, a quick overview of the market. A lot of people feel it's really a very odd time. I feel that way, although I've been doing this for approximately 28 years. So there's a lot of things that feel off at different times. And you wonder, is it just another normal cycle? But this may be a bit different. Why don't I get your thoughts overall on the market or where we're at? You've been doing this a long time as well. Just curious on your perspective.
Yeah, I feel like I've had the good fortune to live through a lot of unprecedented periods in markets, one after the next. This is really only the latest one. So at least for me, it feels different for a few reasons. I somewhat jokingly said, although it's serious business, we live in a day and age where the tweet is mightier than the sword. I mean, who would have thought that one man's Twitter account moves markets more than rockets on the other side of the world? It's not an expected situation, at least from my point of view. I think one thing that has changed in this year, 2025, versus the last several years is that there is, in general, more volatility, more uncertainty, more chaos. You can use whatever words you'd like to describe that. If you want to talk about it sort of statistically, it's that the range of possible outcomes is quite broad and broader than it's been for some time. And that means, I think, that when you make investment decisions, you have to think about your hurdle rate being higher or your risk being higher, and therefore the return that you demand being higher. And all that equates to you should be willing to pay only a lower price than you would have paid 6 months ago for anything. Now, the flip side of that is you should be expecting higher returns. So I think some folks will happily say that this world is uncertain and therefore the returns should be crummy. I actually think it goes the other direction, which is the returns are less certain, the environment is less certain, it's more volatile. I mean, after all, it's June 25th. If we were having this conversation on June 18th, we'd probably be having some different conversations, or if it was May 18th, and probably different again in July. But I think the return opportunities are substantially better as long as you avoid the risky outcomes, which are now more risky and more numerous. I don't think any of that's going to go away anytime soon. So my view is that it's a change in the regime. And I also think while it was very uncomfortable for a period of time, I actually think the market's becoming a little more comfortable with it. You're starting to see more IPO activity, more share offerings, some M&A. Those are indications that people who are making decisions with real money feel like they're able to make those decisions with some confidence. And that only happens when people feel like they're operating in an environment that they can understand. So as confusing as it might be to us looking on, I think it's going to become a new normal rather than this is a true aberration. It might go back to being a different new normal later, but for a period of a few years, I think this is what we're working with.
Super interesting. Yeah, you mentioned a wider range of outcomes, higher returns. Maybe delve down a little deeper on that, what you're thinking about it. I mean, I have a lot of concerns when I look at the macro picture, but when I drive around, I mean, our freeways are full, things are thriving. When I'm out at restaurants, the market keeps going. You know, I'm a bit of a trend follower too. It's just been incredibly resilient. Even that comeback off the April 7th lows was one of the fastest in history. You know, really only that COVID comeback in that month was about as quick. So it is an interesting time, but I'm really intrigued by your thesis on things wider range but better opportunities, and maybe how you're positioning or what you're thinking around that.
Yeah, I do think I'd be remiss if I didn't give a little more color. I think the concentration that you've seen in markets among very large cap names at very expensive valuations is likely to be, I mean, it's already to some extent, but is likely to be one of the casualties of this. So I'm not suggesting it's the same playbook works and the returns will continue to look like they looked before. It seems to me that the opportunity set's shifting, and where it's shifting will pay you outsized returns that people almost forgot about. And the thing is, the obvious one to me, and it's always a little bit dangerous because it's the area that I pay closest attention to from day to day because of the liquid fund that I manage on behalf of myself, my partner, and our limited partners. And so I have most of my own capital invested. But I think the opportunity in the smaller sized businesses that have been ignored and left for dead for the last probably 10 years is really pretty compelling. And that's the place where very small changes in appetite for shares can have a huge impact on the price of things. Another, I don't know, several million people buying NVIDIA stock or selling NVIDIA stock is not likely to change the price trajectory of that thing. However, another few people paying attention to $1 billion market cap stock that's dramatically underpriced or has changed its business and been ignored can make a huge difference. And I think when you aggregate, we could well see a scenario, and we saw it for a little bit. It seems to have subsided recently, but a scenario where the market aggregates are roughly flat, but the investment returns for active managers with some skill and looking at the right opportunities can be very positive. And I think that's one of the interesting features of the regime we're in, that we could see indices struggle to perform, but we could see a lot of managers do really well.
Yeah, those are some good points, and I share a lot of that. I think a lot of this is that enormous concentration in the Magnificent Seven or those top five, and some of the PEs I see out there really just sort of stretch my mind, like a Costco or even a Tesla. When I look at it's just,
they can go down by 50% and still be expensive on any traditional measure is kind of the way I think about it.
Yeah.
And what's interesting to me, and I think maybe it's starting to resonate with people. I'm sort of the man who knows too much because I've paid close attention to these things, but the time to sell those really expensive things that have done really well is before they start to go down. And that's the hard part. Because if you look at the lessons of 2000 and many other bubbles, companies that are wonderful companies that never were close to going out of business, like Cisco and other things, are still 50% below the highs they registered in 2000. We're 25 years on. So if you had sold and bought other stuff, you have a lot more money
Right.
before than you did if you didn't. And some of the names have recovered. There's obviously like one can find other names, but the studies that say if you bought every dip, you've done really well. The conceit of those analyses is that you buy the lowest point, and nobody does, and that means that you've sold the highest point. And so I think the better analysis is thinking about when those conditions are like when you've done well enough out of those things, and when the imbalance is so great that the other opportunities look interesting and they're starting to work, which is I think the world we're in now.
Yeah, it is interesting. I too was around in 1998, the global. I just remember that Cisco, Intel. There were four companies that were just wouldn't stop. Well, they never hit those highs again. You look at where Intel is now. It's tough to say, yeah, sell out it, because these trends with the Costco and video, they just keep running and stretching and stretching. Even though they're really strained and stressed, it doesn't mean they couldn't keep carrying on in that direction. And they're obviously unbelievable, world-class, best at what they do, businesses. But I get your point. Some of the value stocks, the smaller have been ignored. Even within the S&P 500, those other 493 companies have really been ignored. And we've had some interesting discussions even on this podcast about AI and things like that, how a lot of these efficiencies may feed in where those kind of companies start benefiting rather than the people just manufacturing those technologies. When you speak to these companies, are you finding things more attractive in private markets, public markets, or is it just individual, or what's your overall thought around that?
It's a great question. And I think I've been to, since we met at that conference in Carlsbad, that was maybe the third conference I had gone to in a row, and I've been to probably 5 since. And they range up and down the coast of California and up to Canada. And I spent some time in New York. I've had some reasonable soundings. And in general, the institutional investment world and increasingly the private investment world is really focused on the opportunities in private things, and particularly private credit. And this is an area we know really well. My former business spent a fair amount of time thinking about particularly structured private credit. And my business partner founded, built, and sold a business that is largely private credit, is now part of one of the largest global managers, and was the chairman of a publicly listed business development company focused on private credit. So it's a space we know really well. I don't think I'd be talking out of school to say a guy doesn't sell a business that he's built because he thinks the opportunity set has run out of road. He thinks there's great opportunity, but he thinks the prices are full. And that the person who's buying it rather believes there's a lot more opportunity in their system. So I think on the one hand, it's a great opportunity, but it's a great opportunity as an asset gatherer. And that means that it's really well capitalized. And I think we worry that there's so much capital chasing opportunity that the underwriting is not what it should be. And that a number of features of the private market mean that whereas we public market participants have taken our medicine many times over during the last several months, the private markets, there's still a lot of processing, I think, of things to happen. Like if you look at private equity, the realizations that they need to make the system work are not happening. So the time frame of fund life is extending dramatically. And the impact of that is you don't make any more money, right? So all that happens is your IRR goes down. And the only way they're getting realizations is to sell to other private vehicles constituted by other private managers,
Mm.
the so-called pass the parcel. So it's I think from our point of view, there are some pigs going through pythons in the private world that mean that it's a very difficult thing to want to own existing assets. Now, that begs the question of, if you're putting new capital into that market now, are there interesting opportunities? And I would say yes. To me, the most compelling thing and what I'm looking to increase in terms of long-term holdings from that long-term endowment sort of hat of mine is, I think there's a great opportunity in very small buyout firms that do two things. One, that buy very small companies, and I'm talking like $5 or $6 million of EBITDA, and they buy several of those and professionalize them and grow them into a platform that they can sell to a larger private equity firm that has considerably more capital and that values the kind of ready to go nature of the asset they'll be buying. Whereas these guys who play in that smaller space are really doing just the blocking and tackling, hard work. It's repeatable. It's not a risky or difficult business plan to execute, to just improve, professionalize, get something off QuickBooks, have an actual CFO for 10 businesses together rather than one, and grow from there. So that's one thing. And then the other is, I actually think there's a great opportunity in the firms, which is small in number relatively, who are willing to buy companies off the public markets. Because as we talked about earlier, I think one of the biggest areas of inefficiency is smaller and up to middle-sized businesses. So maybe that's up to like 5 billion in market cap. They've just been completely ignored in the market space. And we joke, our portfolios, we have 15 companies that we have invested in at any one time. And okay, maybe 2 or 3 of them are not necessarily better off being owned by somebody else, but at least 10 of them are at the wrong price and would be better owned by somebody else who could pay a meaningful premium and still make a ton of money in the long term. So I think for people who are willing and able to do that, firms that are willing and able to do that, it's really interesting. So those are the 2 private equity areas we're looking at. And I think in terms of private credit, we're really pretty cautious. I think the other thing, the business cycle, I think we have to admit, we don't really know where it is. The credit cycle is still processing the repricing and floating rates that come through with that. And there's a lot of incentive for people to amend and extend, and we've seen that. And I think a lot of the private credit that one can buy and evaluate is actually tied up in those larger private equity deals. So you're kind of making the same bet in a different way. And we don't love the bet at this point. So we're kind of watching from the sidelines in terms of private credit. One thing that we think is interesting and worth keeping an eye on is the so-called democratization of private credit. So as you have more liquid, the ability to invest in that through more liquid funds, I'm thinking of like interval funds and evergreen funds and these different structures. Some of them seem like they're probably able to withstand a liquidity squeeze if it happened, but my guess is not all of them will, and there'll be some innovation that exposes the very long-term investment strategy to the realities of a short-term liquid market, and that mismatch is usually dangerous.
We haven't seen that occur yet. The demand is there, and it's worked out fine. And we set the expectation of the quarterly redemptions, and that we try and build into portfolios where they have other areas they could access liquidity that's very easy to get at, and come from the perspective this is more institutionally driven, where they have longer time frames. I mean, the one space where I've seen it, is just in real estate, private real estate. So folks are getting out of that left and right. I took some small exposure there. Don't love it. I've been backing out, but we've had to take several quarters to exit out. Like they would prorate what we could get out. And it wasn't that anything was broken or horrible. It's just we saw better opportunities. And then, for example, we could see double the yield in private credit and probably a better looking space. So nobody's leaving that space now, but we've had to do it over what I call a few trips to the plate to bat, and some of them it might take 5 quarters, but we get out. It doesn't mean they're bad assets. It
No.
might be Aries or something, but just more attractive. So far, those have worked well. We, as a firm, we do extensive diligence on the managers, on who's doing this. You mentioned the analysis. You really want to be able to hang their hat on, how they're doing that, what they're pricing in, their processes, their level of expertise. There's a lot of choices out there. They're not all equal. And there's a few really kind of leading edge with just great processes that are built for this. And the democratization, I think, in a way has been a good thing, because part of me sort of rebels against the attractive asset classes for, this day and age and going forward, but that where they're not accessible to normal folks. It's only large endowments. And, why should, the title of the podcast is The Millionaire Next Door, the overnight 25-year success story. So a lot of those folks are just folks that built their stuff through persistence and time and processes, maybe working with someone like myself. So I think it's exciting if they have the right guidance and they understand that. But having said that, it is a little bit of a brave new world. But we are finding a lot of that, especially, I attend a lot of these conferences too, and sometimes it's kind of mind-numbing, all the information. But certainly the private infrastructure and that kind of theme has just come across, and we've explored that quite a bit on this podcast. We have some more discussions on that. Do you have any thoughts around that? It just seems like some sort of unlimited demand or a lot of need, and it's going to have to happen to move this, the global economy forward. It's unbelievable.
Yeah, I think two things. One, and I think I would underscore exactly what you said, which is the so-called democratization. Like I believe very strongly that actually, I guess what I would say is there's a bifurcation. So the more institutionalized a market gets, generally speaking, the less it likes volatility, and the more comfortable it is with exchanging lower volatility for lower returns. And as an individual investor, as an individual, you shouldn't. That's not okay. Like in my view, it's better to tolerate a little bit of volatility, or the average individual is willing to tolerate higher than institutional level volatility, and in exchange can generate much better returns. So I think working with a professional like you and being responsible about how you're going to manage your liquidity picture is the right way to do that, right? You can then find the nichier operators the nichier managers rather, that are going to attack specific areas of opportunity that are, you're not constrained by having $23 billion in a fund you have to deploy. You're able to sharpshoot somebody much more thoughtful and focused. And they're not as focused on defending a franchise. They're focused on building a legacy, which is exactly what most of your clients have been doing for their life, right? I mean, that's kind of where I think folks in our area of the world can really find ways to outperform the big giants. But I think, to your point, infrastructure, it's the same with private credit. As in private credit, it's like, as large banks have more capital requirements and less risk tolerance, they're pulling back the reins on lending they're just bringing the size bar up of who they're loaning money to. So there's more opportunities for third-party lenders to step in. I think in infrastructure, the projects are so big, the need is so great. And, if you aggregate, I think I saw a statistic that it's not all being spent on infrastructure, but that the US government spent more money in the years between I'm going to get the years wrong, but more money in the last 7 years or 10 years than it did in all the armed conflicts of the 20th century combined. And when you think about that, that's a lot of money. And when you think about the economic impact it had after all those different wars, it was dramatic. So the impact on infrastructure is bigger than anybody can attack. Of course, there's going to be tons of opportunity, and it's all about finding the right partners, right? And the right structure.
Yeah. And to your point, I've looked at a lot of statistics, the money creation, the M2, really since the global financial crisis is just, they've tripled the money supply. It's just it's unbelievable when you see this data. So even the global financial crisis looks really small compared to the infusions that took place during COVID. And I
Yeah.
saw a statistic the other day. So they showed, say you take a dollar, right? And they showed since the global financial crisis, we've created if you have a dollar, 67 cents of that has come since the global financial crisis. The other 33 was like the other preceding 200 years of the country. And so to why that's such a big deal, that obviously displays why inflation just exploded, right? And a lot of economists acted surprised, but it's pretty basic. It also kind of drives my mission of why we need to continue to grow people's assets, because the world's just going to become tremendously more expensive. That's just the way it goes. A few weeks ago, my son graduated from college, a UC school, runs 30K. I don't want to date myself, but it was $1,200 when I went there. And my dad went to UCLA, and I think it was $50. I mean, it was a long time, but there's your inflation, right? It's pretty,
Yeah.
Go out for a basic hamburger burrito, and it's really not that shocking to pay $20. So we need to keep growing that. And to your point, to be too conservative, if you don't have enough capital, we need to grow our way through that. And those they're starting to bring down the money supply, but the explosion is really shocking, which is why we're cautious on things and want to be really careful and deliberate about where we allocate. But we do see a ton of opportunity too. We live in a really exciting world with a lot of stuff changing. There's just no question.
Yeah, no, I mean, I think it's like when I just look at the range of stuff that opportunities we see. I mean, we have everything from a common equity yielding 16% straight through to something that we think is really deep value that we think can triple. And I actually feel like that's so on a micro level, that's like our portfolio and our investment fund. I think when I construct at the other end of the spectrum, when I'm constructing a portfolio for an endowment, I look at it like we want to have a portion of our assets in purely passive things. We want to have a portion of our assets in things that we think are going to pay us 10, 11, 12% year in, year out. So that's sort of your private credit, your infrastructure, et cetera. And then we want to try and generate real alpha through thoughtful managers for actually the bulk of our capital in the middle. And what I think is pretty interesting to me is like when we talk about infrastructure, I just look at it as in most cases, it's secured lending. So it's actually another private credit vehicle. Same as if you did like low LTV, short-term financing in real estate. It's another private credit vehicle, or royalty financing, or litigation financing, or whatever.
Yeah, we're starting to bake a lot of that into portfolios, and it's been great. One of they actually have access to these sports teams now, which could be Manchester United, Real Madrid, the Miami Dolphins. I see these on a standalone basis, and usually the commitments are really, really high, and I'm not quite ready to go there. But the Dodgers, I think, just sold recently. It's been in the news they explained, what was originally paid for them and what they're worth now. And it's interesting times. So, hey, I want to start to kind of land the plane and wrap up a little bit, but these are some great thoughts. I really like your view on manage this through a process, but there could be much better returns ahead, and you need to really pick and choose the space. I met with a foundation endowment I deal with yesterday on Zoom and explained they were up like over 10% this year, which they were pleased with. But, it hit me knowing on the inside, sort of, do you understand what that means compared to the indices, to the aggregates you referred to? It's a pretty big, it's not an easy thing to do, but yet we've done it and probably paired their risk a lot. But just love to hear you kind of any closing thoughts maybe you didn't cover or things that stand out, and super appreciate you being here. But yeah.
No, I just think it's first off, I'm really grateful for the opportunity to have this conversation. I enjoy these things tremendously. We had a great lunch. So I appreciate that. And I just think, to me, it seems like this is a great environment if one doesn't get too wrapped up in, you can enjoy the news cycle, enjoy the various comings and goings of friendships and things in the press that you can observe, but don't get too wrapped up in it. And, I think we're sort of in the camp of your people where we feel like if we've been nimble, we've managed to come through. We're like 8 or 9% up on the year and feel pretty good about that, which, like, you'd love to be up more always. But I think it's a really good environment for thoughtful folks. I think finding somebody like you to help guide and construct things thoughtfully so you don't end up in a liquidity problem having to sell when things are in a poor place, and you can instead be on the front foot for risk, that's going to make all the difference.
Yeah, I agree. It's almost people are so focused on the news and finding stuff on social media. It's not always great information, or they might have a lot of knowledge, but I have been kind of really letting a concept sink in recently, just around the difference between knowledge and wisdom. And I heard a great one the other day that I really liked. They said to differentiate knowledge, knowing that a tomato is a fruit, but wisdom is knowing that a tomato doesn't belong in a fruit salad. So I really like that. But sometimes we just try and give them that perspective. And always kind of tune out the noise. There is more noise than I've ever seen. And that doesn't always mean that everybody's thinking through it and really, especially when the news changes all the time, depending upon what side of the bed someone wakes up on, So
that's the point.
Yeah. So, Zach, this was fantastic. Maybe we'll schedule another sort of check-in, update powwow, just to sort of brainstorm through some thoughts of the day. And super appreciate you being here. This has been great. So, I really thank you for sharing what you're thinking, your process.
Yeah, thanks so much. I really enjoyed it.
Wonderful. Well, thanks everyone for tuning in. Please, if you're getting value out of this, like it, share it. Feel free to reach out to either one of us. We'll put Zach's contact info in the show notes. And everyone, make it a great day. Thanks for being here.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC-registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities, LLC, member FINRA SIPC. Investment advisory services offered through SEIA, LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.